Employers Holdings, Inc., ticker EIG, just delivered a massive bottom-line beat for their second quarter 2026 earnings, adjusted EPS 70 cents.
Which is what, up 46%?
Up 46% year over year, yeah. And diluted EPS came in at $1.59, so that's a 29% increase. But here is the absolute riddle for your financial models today. They achieved that earnings surge while intentionally, and I mean aggressively, shrinking their own revenue base.
Right, taking a total axe to the top line.
Exactly. Gross premiums written fell 19.6%, down to $163.4 million. Net premiums earned dropped 12% to $174.1 million.
Wow.
Yeah. And, while the company didn't issue explicit Wall Street consensus numbers or forward earnings guidance in this release, and we don't have the immediate after-hours stock reaction in front of us, the raw data paints just a fascinating picture.
It really does. It's a company deliberately sacrificing market share to prioritize margins. I mean, it's the practical execution of addition by subtraction. You hear management teams in commercial insurance talk about disciplined underwriting all the time.
Oh, constantly. It's a favorite buzzword.
Right, especially when market conditions get tough. But it is incredibly rare to see an executive team actually walk away from a fifth of their gross premiums.
Yeah.
That's not a tweak. That's a structural shift.
And that structural shift is exactly the mission for today's deep dive. We are going to unpack exactly how EIG managed to grow per-share earnings by nearly 50% while intentionally shrinking the business. We'll get into segment performance, management's recapitalization strategy, and just the mechanics of how a shrinking business prints more money per share.
Yeah, let's break that down, because I think people hear shrinking revenue and immediately panic.
Exactly. So let's ground this in a really practical analogy for everyone listening. Imagine you own a restaurant. It's packed every night. Top-line revenue looks amazing, but a quarter of your tables are in this terrible location in the back. They take way too long to turn over. Your wait staff is constantly running back there. And the guests, they only order tap water and, a cheap appetizer.
Right. So your operational effort is completely outpacing the actual financial return.
Exactly. You're burning resources just to maintain this illusion of volume.
Yeah.
So you make the hard call to just close that section of the floor. Your overall revenue drops immediately. You're serving fewer customers.
But your profit margin per remaining table just skyrockets.
Because you're only dedicating resources to your most lucrative patrons. And then take that a step further into the corporate finance realm. Imagine you take the concentrated profit from those good tables and you use it to buy out one of your silent partners.
Ah, right. Fewer owners at the table.
Exactly, meaning everyone who remains gets a significantly larger slice of a much richer pie.
That restaurant scenario is basically EIG's quarter in a nutshell. I mean, CEO Catherine Antonello has been pushing this discipline strategy, right? They intentionally let gross premiums written drop that 19.6% because they literally just stopped writing and renewing bad business.
They'd rather have no premium than bad premium.
Exactly. They started these deliberate pricing and underwriting actions back in 2025. They walked away from pure premium volume to prioritize profitability. But, and this is key for your models, the real driver here, the reason adjusted EPS expanded by 46% is that second part of your analogy, the buyout mechanism.
For share buybacks.
Yeah, the buyback engine. The capital return breakdown here is just wild. EIG returned $34.0 million to stockholders this quarter.
Wow.
And out of that total, a massive $27.7 million went directly into share repurchases.
Do we have the share count on that?
Yeah, they bought back 651,752 shares at an average price of $42.43.
Okay, so that's where the math really works in the retail investor's favor. When you shrink the denominator, the total outstanding share count, while simultaneously improving the underlying margin of the business you kept out.
You get massive leverage on earnings per share.
Right. It's financial engineering, sure, but it only works if it's backed by actual fundamental operational discipline.
Yeah, otherwise you're just masking a declining core business. You're buying back stock on a sinking ship.
Exactly. So let's open the hood and look at the actual insurance operations. Do the combined ratios actually reflect this discipline? Because the policy count seems to be the first major tell here. Policies in force declined 5% to 127,601.
Right. And you really have to weigh that 5% drop in policies against the 19.6% drop in premium volume.
Oh, that's a huge gap.
It's a massive gap, and it tells a distinct story. They aren't just shedding clients randomly across the board.
Hmm.
They are specifically dropping large, unprofitable premium blocks while holding onto the smaller, stickier accounts.
Which reflects that deliberate shift toward their core small business segment.
Exactly. Where they've historically had much better pricing power and, honestly, more predictable loss trends.
Well, the loss metrics definitely back that up. The loss in LAE, which for those newer to insurance models, stands for loss adjustment expense. Basically, the cost of investigating and settling claims, that ratio improved to 70.2% from 70.7% a year ago.
And management also noted their actuarial review confirmed absolutely zero prior period development on their voluntary business.
Right, which is huge. Can you unpack that actuarial side a bit? Because that's a critical detail for anyone building a long-term model on an insurance company.
Sure, yeah. So when a claim is filed, the insurer sets aside a reserve. It's basically an estimate of what the final payout will be.
Like a placeholder for the cash they'll eventually need.
Right, but sometimes, years down the line, medical costs inflate or legal fees end up being way higher than that original estimate.
And if it's higher, they have to take a charge to catch up.
That's exactly, which hurts current earnings.
Yeah.
So EIG having zero prior period development on their voluntary business, that means their old reserves are perfectly calibrated. They aren't getting hit with nasty surprises from, slip and fall claims filed 3 years ago.
It gives you a lot of confidence in the integrity of their balance sheet. And we also saw the commission expense ratio improve, right? It dropped to 12.8% from 13.2%.
Yeah, management attributed that to lower agency incentive accruals and just less new business being written.
Which makes mechanical sense. New business generally carries a higher acquisition cost, elevated broker commissions. If you're intentionally suppressing top-line growth and just focusing on renewals, your commission ratio naturally trends downward.
Exactly.
But and I want to push back here a little bit. If I am an analyst scrutinizing this release, there is a glaring red flag regarding internal costs. We keep talking about margin protection, but the underwriting expense ratio actually increased.
Yeah.
It moved to 22.8% from 21.7%. That's over a full percentage point of margin erosion on the operational side. So is EIG losing control of its internal overhead while it shrinks the overall book?
No, and that is such a common trap when analyzing an insurer that's undergoing top-line contraction.
Yeah.
You really have to look past the ratio and examine the raw dollars to understand the denominator effect.
Okay, lay it out for us.
EIG is not losing control of internal costs. In fact, their actual underwriting expenses decreased by 7.9% year over year.
Oh, wow. They dropped down to $39.7 million, right? That's a decrease of $3.4 million in pure cash terms.
Precisely. They spent less actual capital on policyholder dividends, bad debt, compensation expenses. The pure dollars going out the door for overhead shrank.
So why did the ratio go up?
Because the denominator, the net premiums earned, shrank by 12%. When your revenue contracts faster than your fixed operational costs in the short term, your expense ratio is just mathematically going to tick up.
Right, it's a math quirk, not an operational failure.
Exactly. The actual operational spend demonstrates really strict discipline.
That denominator effect is just a vital concept for keeping your models accurate. But let's zoom out to the broader combined ratio, because there is an anomaly in this report that can really distort a run rate calculation if you aren't paying attention.
Oh, the restitution.
Yeah. So EIG posted a 105.8% Jack combined ratio. Now, in insurance terms, anything over 100 means the company is paying out more in claims and expenses than it's taking in from premiums.
Right. And they highlighted that excluding the LPT, the loss portfolio transfer adjustments, that combined ratio, sits at 106.7%.
Just for context, a loss portfolio transfer is essentially a reinsurance mechanism. It's where an insurer pays another company to just take old, unwanted claims off their books. It cleans up the balance sheet, but it can temporarily skew the current quarter's ratios.
Yeah, but you are completely right to point out the anomaly because there is a one-off event that's artificially flattering that 106.7% figure. EIG recorded a $2.5 million premium restitution from a former policyholder.
Okay, a premium restitution. Let's unpack what that actually means in practice, because that sounds like a line item that can easily slip past a casual read of an earnings release.
It absolutely can. So in workers' comp, premiums are often based on estimated payrolls for the year. At the end of the policy term, the insurer conducts an audit.
To see what the actual payroll was.
Right. And if the actual payroll was higher than estimated, the client owes additional premium. In this case, a former client owed them a substantial amount of money, which usually requires like a legal settlement or a really prolonged collection process to recover.
And EIG successfully recovered that $2.5 million.
Yes, and because it's related to past business, it drops straight to the bottom line of the current quarter's underwriting result.
And management explicitly notes that this single restitution favorably impacted the second quarter combined ratio by approximately 150 basis points.
Exactly. So if you are attempting to project their true run rate profitability for the remainder of 2026, you absolutely must strip that 150 basis points out of your model.
So their underlying combined ratio, excluding the LPT and excluding that one-off restitution, is actually running hotter.
Yeah, it's closer to 108.2%.
Okay, so they're taking a slight underwriting loss to reshape the book, which means they have to be making up ground somewhere else to secure a 46% earnings beat.
And that points directly to the other half of the insurance business model, the investment float and the balance sheet.
Yes, the float.
This is where the structural advantage of an insurance company really reveals itself. I mean, an insurance provider is fundamentally a massive pool of investment capital funded by policyholders.
Right, Warren Buffett's favorite business model.
Exactly. Even if the underwriting operations run at a slight technical loss, say that 108% if the investment engine is properly calibrated, the enterprise as a whole generates significant cash.
And the investment engine is definitely performing. Net investment income came in at $27.4 million, which is up 1.1% from the previous year.
And that incremental growth is the direct result of the investment rebalancing strategy they executed back in 2025. They deliberately rotated the portfolio to capture higher yields on fixed maturity securities.
Which pushed the book yield up, 40 basis points to 4.9%?
Yeah. And in a fixed income portfolio of their scale, 40 basis points translates to a material amount of reliable recurring cash flow.
And beyond just the fixed income side, they also booked $18.7 million in net realized and unrealized gains.
Driven predominantly by their equity investments, yeah.
So the asset side of the balance sheet is clearly pulling its weight. But we also need to examine the liability side, specifically the debt structure they utilized to fund this entire shrink-to-grow, buyback-heavy operation.
Right, this touches on the recapitalization plan they initiated late last year.
Yeah. So in the fourth quarter of 2025, EIG issued $125 million in senior debt. And obviously that influx of capital carries a carrying cost. This quarter, they recorded $1.3 million in interest and financing expenses, compared to practically zero in the same quarter last year.
It's the calculated cost of restructuring a capital stack. Management looked at their cost of capital and decided to borrow money at a fixed corporate rate so they could aggressively buy back their own equity.
Because they evidently believed it was trading below its intrinsic value.
Exactly. If the earnings yield on the stock you're repurchasing is higher than the after-tax interest rate on the debt you issued, it's a highly accretive move for shareholders.
And that after-tax calculation is particularly relevant this quarter, given the really favorable tax environment they operated in. The federal and state income tax expense was only $5.6 million.
Which is incredibly low.
Yeah, that translates to an effective tax rate of 16.1%. That's a notable decrease from the 19.7% effective rate they recorded a year ago.
Yeah, that lowered tax burden is a composite of a few factors. It includes tax-advantaged investment income, the tax treatment of those LPT adjustments we discussed, and the amortization of deferred gains.
Can you touch on deferred gains briefly?
Sure. Briefly, deferred gain amortization just involves recognizing past financial gains slowly over a set period of time, rather than all at once.
Ah, which smooths out earnings.
Yes, and
Yeah.
provides specific tax efficiencies. So when you synthesize all these intricate capital maneuvers,
Yeah.
the higher investment yield, the equity market gains, the strategic leverage, the tax efficiencies, you arrive at a much stronger bottom line.
Which ultimately trickles down to the metric retail investors care about most, the book value. So where did those numbers land after all these moving parts?
The growth was really robust. Book value per share, including the deferred gain, jumped 9.0% year over year to $52.58.
Nice.
Furthermore, their adjusted book value per share reached $53.26, which is a 5.6% increase. And this is important for your models. Both of those growth rates are calculated after factoring in the regular dividends they've already paid out to shareholders.
So they are executing a textbook capital allocation pivot. They are shrinking the operational footprint to shed bad risk. They're utilizing debt to optimize the capital stack. And they're driving tangible book value growth despite a challenging underwriting environment.
Textbook.
But having analyzed the Q2 rearview mirror, we have to look ahead at management's forward guidance. Because if the core guaranteed cost product in the small business sector is being intentionally restricted to protect margins, how does the company eventually resume top-line growth?
Well, CEO Catherine Antonello addressed this directly. She stated that profitable growth remains their North Star, their primary objective. The reality of a shrink-to-grow strategy is that it has a finite runway, right?
You can't shrink forever.
Exactly. Eventually, you reach a point where you've excised all the unprofitable business, and you have to find new revenue streams that actually meet your stricter return thresholds.
Which brings us to their major product launch for Q2. In June, EIG officially went live with excess workers' compensation.
Yes. And this represents a critical pivot in their operational strategy. EIG has spent over a century cementing its reputation as a specialist in small business insurance. Their foundational product has always been guaranteed cost coverage for lower hazard Main Street businesses.
Like restaurants, retail shops, light manufacturing.
Exactly. But excess workers' comp fundamentally alters that target demographic.
How so?
It alters both the demographic and the actuarial mechanics of the business.
Okay.
By adding excess workers' comp, EIG can now service self-insured enterprises. These are much larger, well-capitalized corporations.
Okay.
A self-insured enterprise typically pays for its own routine, everyday workers' comp claims directly out of pocket. They only purchase an insurance policy to protect against catastrophic multi-million-dollar losses. That is the excess coverage.
So EIG is essentially moving up market, taking on a completely different risk profile, and diversifying away from that highly competitive, heavily commoditized small business sector.
Right.
But how does that change the internal modeling for the company?
It radically changes their claim frequency and severity profile. In the small business sector, you deal with a high frequency of relatively low severity claims. A constant stream of minor slip and falls or repetitive strain injuries.
Right. And the pricing model relies on volume to offset that steady drip of payouts.
Exactly.
Wow.
But excess coverage for large enterprises flips that model upside down. You experience a very low frequency of claims, but the potential severity of a single claim is incredibly high.
Like a major industrial accident.
Precisely, which means they have to price it differently, hold capital differently, and rely on a totally different set of underwriting muscles. It requires sophisticated catastrophic modeling rather than standard frequency modeling.
Wow.
However, if priced correctly, it's a highly lucrative line of business that can drive the next phase of top-line growth without compromising the margin discipline they just spent the last year implementing.
Right. And while they build out the infrastructure for that new product line, they are ensuring investors are compensated for their patience. Management declared a regular quarterly dividend of 34 cents per share, payable in August.
And we also can't overlook the remaining repurchase authorization. I mean, even after deploying $27.7 million to buy back stock this quarter, they still have $113.0 million remaining under their 2026 program.
That is a substantial amount of latent buying power.
It really is. It signals management's intent to continue aggressively executing this strategy as long as they believe the public market is undervaluing their equity.
All right, let's summarize the key takeaways for your models. Employers Holdings, Inc. delivered a definitive quarter of margin prioritization. They deliberately sacrificed roughly 20% of their top-line premium volume to shed underperforming small business accounts. They utilized the resulting cash flow and strategic debt to buy back a material amount of their own stock, improved their investment portfolio yields to 4.9%, and ultimately drove a massive 46% beat on adjusted earnings per share.
Pretty incredible quarter.
Yeah. Book value is up, outstanding share count is down, and they have launched a new excess workers' comp product targeting self-insured enterprises to fuel future growth.
It's just a rigorous demonstration of how a company can completely re-engineer its financial profile from the inside out, prioritizing long-term per-share value over short-term revenue vanity metrics.
Exactly. Now, if you rely on this level of mechanical breakdown to keep your models accurate, make sure you are following the show. We provide this kind of deep dive daily throughout earnings season, bypassing the fluff to focus on the metrics that actually move the needle.
And as you finalize your notes on EIG today, I want to leave you with a broader macroeconomic question to mull over.
Oh, lay it on us.
We just spent this entire deep dive analyzing how a specialist with over a century of proprietary data on small business risk is deliberately shedding a fifth of its gross premiums. They are actively running away from volume in the small business sector. If a company with that much visibility into Main Street America is intentionally raising prices and cutting exposure, what exactly does their internal actuarial data suggest about underlying inflation pressures, payroll stability, and the overall health of the broader U.S. labor market right now?